Hey guys, Austin Schneider here, and today we're going to talk about how to know when to refinance your mortgage. So refinancing is probably an easier decision than you think. If you can save money by refinancing, then you should probably refinance. But where a lot of homeowners get caught up is the fact of if they're actually going to save money at the end of the day. You know, there's closing costs and really uncertainty if they'll have the loan long enough to recoup the closing costs that are involved with a refinance. So what we're going to do in this video is break down and make the calculation really easy for you. Plus we'll go into many other reasons why refinancing might be a good decision for you and your unique situation. But first things first, guys, refinancing is not always the easiest process. Of course, you would take a lower rate if you could skip all the paperwork, the appraisal process, talking to all the lenders, and a lot of front loading of work that is needing to be done from the homeowner's perspective. So what we'll focus on is situations where, you know, it could be worth it. As we mentioned, guys, one of the hardest parts about refinancing is deciding whether or not you're actually going to save money at the end of the day when you're going with a refinance. Refinancing comes with closing costs such as title and escrow, lender fees, appraisal, and more. So you want to make sure that it's money well spent at the end of the day. The first method to determine if refinancing is going to be a good option for you is just simply the break-even method. And in this method, it shows us how long it's going to take to recoup the refinancing cost. Say for instance, if your closing costs are $3,000, but you're saving $300 a month, then it'll take 10 months to recoup your costs. But if you're in the same situation and have $3,000 in closing costs, but it's only saving you $30 a month, then I probably wouldn't refinance because it's gonna take you 100 months or up to 8 years to recoup your closing costs. And the average loan term is around 5 to 7 years. And what we really wanna look for is recouping your closing costs under 2 years. If you're looking at the break-even method, disregard payments such as taxes and home insurance because you're gonna be paying those regardless. These costs aren't associated with your loan whatsoever, and you'll be getting a check reimbursing you from your lender for these costs. What you want to look for in closing costs is simply title and escrow, lender fees, appraisal, and more. Second thing you want to look at is your interest rate savings, not your payment savings. To avoid overestimating your savings, do a quick calculation. So if we're looking at a $300,000 mortgage with a 1% rate drop, that would be $3,000 interest savings per year. 1% of $300,000 is $3,000. $3,000 divided by 12 months means you're saving $250 per month in interest. And the break-even method is not your final answer. You might have other priorities such as lowering your monthly payments, which we'll look at on the next method. So the second method that we're going to talk about is the cash flow method. If you're really struggling to make your monthly payments, you might want to drop them with a refinance. For example, if you're paying $1,500 a month right now in mortgage and you are able to drop your monthly payments to say $1,350, then that's probably going to be worth it for you. You may choose to refinance even if starting over in a 30-year loan might cost you a little bit more in the long run, but we'll talk more about resetting your loan term later on. The third method when determining whether you should refinance is the no closing cost method. Any lender can offer you a no closing refinance. What this means is that you will not be paying the closing costs up front, but in the long term, it will be rolled into your new mortgage and you will be paying the closing costs over the course of your 30-year mortgage or however long your mortgage is. That credit will go into a higher interest rate than you would if you were paying the closing costs up front. How this works is that the lender will give you a slightly higher interest rate and a credit for all of the closing costs. That could sound counterproductive, right? Well, not necessarily. Higher than market interest rates could still be lower than what you're currently paying. And you should refinance if you can drop your interest rate without needing to pay the closing costs. Let's look at an example. Let's say you have a 4.75% 30-year fixed loan. Current rates are at 3.75% at $3,000 in closing costs. But the lender can give you a 4% rate with no closing costs. You'll still be able to knock almost a percentage, 0.75% off your rate, but you pay nothing except the time it takes to shop for a lender and apply. There's no risk in refinancing except one: resetting your loan. So what happens when you reset your loan term? This is something to consider even with a no closing cost loan. While your rate could drop and you can avoid paying closing costs, what could happen is that you will be paying more interest overall. Let's look a little bit deeper into this. Let's say you've been paying your 30-year mortgage for 7 years. So you have 23 years left on it. You're at a 4.75%, but you can get a 4% no closing cost loan. Sounds like a good deal. But remember that you're going from a 23-year loan back to a 30-year loan. So what are the true costs? Let's look at a $300,000 loan balance. In this situation, your payment drops from about $1,800 a month to $1,400, a huge monthly savings amount. And if all you're interested in is cash flow, that's a great deal. But if your main priority is saving on lifetime interest, let's look again. At your current rate of 4.75%, you'll pay about $190,000 in interest if you keep your loan until it's paid off in 23 years. With the new 30-year loan at 4%, you'll pay $215,000 in interest over 30 years, an additional $25,000. So the refinance isn't as good as a deal as you thought. So what's a good solution to this? Well, ask your lender to quote you on a refinance of a 20 to 25-year loan. So in this situation, your monthly payments will stay about the same on a 20-year loan, but your interest savings will be drastic at about $55,000. So if your main priority is lifetime interest on the loan, then selecting a shorter loan term could be a great option for you if you are considering a refinance. So up until now, we've been talking about refinancing for a lower rate, but there are many other reasons to refinance, which we're about to get into. Another reason to consider refinance if you want to cancel your private mortgage insurance. If you purchase a home with an FHA or with low down payment, less than 20%, you likely have PMI, private mortgage insurance. What you can do is refinance into a conventional loan if you have up to 20% equity on your home. Let's look at some potential savings on this. So if your current balance is $250,000 at 4.5%, your principal and interest payment is $1,230, PMI is $240, so your total payment is $1,470. If you refinance into a new loan at $250,000 at 4%, your principal and interest is going to be around $1,150 with no private mortgage insurance, totaling your payment to be $1,150, saving you $320 per month. Even if you don't lower your interest rate, you can still save a ton of money just by having the equity and leveraging the equity that you have in your house. Another reason to consider refinance is to reduce your loan term. Like we just talked about earlier in this video, you can save a lot of money refinancing from a 30-year to a 25, 20, or a 15-year mortgage term. As the term gets shorter, rates get better. Rates at a 15-year mortgage can typically be around 0.5 to 0.75% lower than the conventional 30-year mortgage rates. So these can be a great value for you as a homeowner. Another reason to consider refinance is to increase your loan term. If you're in a 15-year mortgage or a 20-year mortgage and your payment's just a little bit too high for you, you can refinance into a 30-year mortgage, which will make your monthly payments significantly less. Your rate might be a little bit higher and you'll end up paying more interest at the end of the day, but if cash flow and monthly payments are your priority, this could be a great option for you. Another reason to consider refinance is if you are in an adjustable rate mortgage and you want to refinance into a conventional rate mortgage. So with an adjustable rate mortgage, usually the rates are low at first, but they could be volatile to the market and they could end up going up. So if interest rates are really low right now, you might consider refinancing into a conventional to lock in a good rate for the lifetime of your loan. Another reason to consider a refinance is if you want to get cash out. So as you pay down your mortgage and interest, you build equity in your house. You can get a cash out mortgage, which is when you take out a bigger loan than what you owe on the home. If you owe $200,000 on your home, then you can get a new loan at $300,000 and get $100,000 in cash. And you can use that cash to fix up your home, college, pay off debts, however you please. Another reason to consider refinance is to consolidate any debt. If you have any high interest credit cards, auto loans that you want to pay off, you can roll that into a new mortgage. And what you'll do is you'll roll all of your debts into a new mortgage using a cash out refinance. And this will allow you to pay off your debts and free up your monthly cash flow. And keep in mind though, if you are going to go with the route of paying off your debt with refinance, you will be paying the debt off in the term of 30 years. And really the best option is to go the old school, old-fashioned way and continue to pay off how you were to save you money in the long run. But again, if your priority is monthly cash flow, this could be an option for you. Another reason to consider a refinance is if you want to pay off any liens, second mortgages, or judgments. You may have taken out a second mortgage known as a piggyback loan, or maybe you got a home equity line of credit on your house a while back. You might have other judgments or liens on the house that you might want to say goodbye to. And you can get a cash out refinance to pay off all the liens into a single mortgage. And this will allow you to get rid of those extra payments and make your life much simpler. So guys, this was a lot of information about when to refinance or if it even makes sense for you. For more on this topic, for more about refinancing, be sure to visit us online at themortgagereports.com. Thank you so much for watching. We will see you on the next one.